A lot of investors I partner with have one major challenge. They are busy professionals that love to create memories with their families, but are too busy to actively look and find value-add real estate that cash flows. Hey guys, I'm John Fortes, and I want to partner with you. I provide investment opportunities through apartment syndications that allow my partners to invest passively so they don't have to worry about trading more time for money. If you are interested in creating passive streams of income, wealth creation, and all the tax benefits that come along with investing through real estate, I encourage you to fill out the form at www.investwithfortes.com. Invest today so that tomorrow you can trade money for time. Once again, that's www.investwithfortes.com. And I can't wait to partner with you.
Are you a busy professional looking to diversify your portfolio? Ever wanted to passively invest in real estate but don't know where to start? John Fortes provides you with a guide to passively invest in real estate. This is the Passive Investor Show.
And now, the Passive Investor Show. Here's your host, John Fortes.
Hello, PI listeners. Thank you for lending me your time today. Welcome to the Passive Investor Show. I'm John Fortes. Our goal is to provide you, the busy professional, with passive investing tips and tricks for your real estate investments to leverage more time for you to focus on your true passions. Let's get to work. Hello, PI listeners. I'm excited to bring Jason Howell to you guys. Jason and I met at Multifamily and More. They put together a great mastermind event. Me and Jason literally hit it off, and I'm excited to bring him to you guys because the simple fact of how important piece of the puzzle Jason's product and his services are to a multifamily component. So Jason, welcome to the show and tell us more about you.
John, thanks a lot for having me today. I really appreciate it. Just a real quick background on myself. I was lucky enough to, go to the Naval Academy, start off in the military, and got involved in real estate investing when I was a young kid. And one thing led to another. Now, I run a Fannie Freddie small balance multifamily lending program, and I'm lucky enough to work with a lot of great investors across the United States, buying apartment buildings, whether it's for their retirement or just for several other investors. So it's a great space to play in. Usually everything we do is between $1 and $10 million, all the markets across the country, from Chicago to Seattle to small towns in California to San Diego to Florida and Dallas. So it's a great, exciting times for us in the agency lending space between $1 and $10 million. And I know we're going to do a couple loans with you too here pretty soon.
Absolutely. We're already talking, and I love it. Real quick, Jason, thank you for your service. I love that. And another thing, and you made it sound like everything happened in 2 minutes. So how did you get to where you were to having an agency company like this?
Well, it's kind of interesting is, excuse me. I grew up in a military family. I grew up in, a moderately small town, and, I got out to California, and, I was making a couple $1,000 a month in the Navy, and I read Rich Dad, Poor Dad, and I wanted to find a way to kind of grow my, net worth and my passive income. And I started, dabbling in single family homes, then condos, then little apartment buildings. And so it kind of grew from there. And my passion and my desire from real estate kind of went a couple different directions when, I started off in the, call it the private equity development space. Then I ran a property management company for a while. Then I ran an asset management company for a while. And then I got involved in acquisitions for a good period of time. And then, I hooked up with the Sabal folks, buying distressed loans back in the day when the world fell apart. And one thing led to another. We started a lending company, and Freddie came to us and, asked us if we wanted to be part of their small balance lending program, and we jumped on it. And, myself, I actually was a little bit scared. I was like, I've never been a lender before. Maybe I should not do this. And but it was great though. I ended up jumping into it. I've loved it. Been doing it since 2015. June of 2015 is when we launched the Sabal Freddie Small Balance platform. And today we're doing Fannie and Freddie. We're doing $1 billion to $2 billion a year of all different kind of loan types across the country. But I feel very fortunate. But I love seeing all these great investors out in the marketplace buying their first deal, looking to be self-sufficient. We're providing great non-recourse financing for them, their partners up to 80%. So it's great. So there's kind of my small little story. Whatever I get now, it's like 2 minutes now. So, but it's been good. I feel very lucky to go from the military to where I am today to work with people all across the country.
That's pretty awesome, man. Thank you for sharing that. And why I thought this was important to have you come on is because the lender is the general partnership's biggest partner, as well as the passive investors. So tell us about the type of programs you come across and the type of deals that you come across with other syndicators.
That's a great question. We do a couple things across the board, and I'll break it up a couple different ways. And you can kind of interrupt me or ask me questions along the way. But the easiest way to look at the agency financing programs, Fannie and Freddie, is our goal is to help keep housing affordable across the country. And so we're providing non-recourse, higher leverage loans than your traditional bank will. So, for instance, we might do 80% leverage on a $4 million, $3 million apartment building in a town where the banks will traditionally offer only 65% leverage. The nice part about the Fannie and Freddie programs too is that, there's no strings attached. We're not looking for bank accounts. We're not looking for, a credit card. It's also, the fact is, it's not cross collateralized with other assets that you own. So, the easy, simple answer to how we provide, how we help investors and syndicators, that one is, we provide great non-recourse, higher leverage financing across the country in almost every market in America. And then the second part of it is that, you have a loan where, a lot of syndicators, and one of the loans that you and I were talking about earlier before we, got on the podcast was, you have a property not very well maintained or had an operator that owned it for a long time. You're trying to raise the rents, you have a bridge loan on it, or maybe you're using your own cash, and, you upgrade the units, you raise the rents. We're a great cash out refinance for that, to put it on a 5, 7, or 10-year long-term, non-recourse loan where we can take you out in that first, year, 2 years, where sometimes the banks won't be as aggressive as we will to help you lock in that long-term debt and lock in your long-term returns for your investors.
That's awesome.
Does that help?
You just it really is. Can you explain to me?
That's all I got, though. I don't have any other answers for you today.
No worries. No worries. Can you explain the difference between recourse and non-recourse?
I would say the easiest thing is that, the way I would explain it is, the non-recourse loans that we provide today is, you basically, unless you perform, bad acts, the loan is really secured by the property, not you personally. So when you have a recourse loan from a bank, they could come after you personally if something happens with that property, or if the loan, if the property catches on fire or something of that nature. The non-recourse nature of the loan makes it so that you can also, that they're not going to come after you unless you've done something, criminally wrong. So it kind of gives you that level of comfort that the asset is basically covering is what they're looking at for the collateral of the loan. The other nice thing about it, though, too, as as a syndicator, as an investor, and when you're growing in the marketplace, it doesn't tap into your balance sheet. So, recourse loans, you have to, basically let other folks know that you have those recourse loans, and it could stop you from being able to borrow at other institutions. And a non-recourse loan does not tap into your net worth, your liquidity, things of that nature, so you can't continue to, to grow your balance sheet. Does that help? I mean, I know your experience might be a little bit different than mine. I mean, that's my kind of overarching recourse, non-recourse, kind of trying to make it really, really simple. But, from the Freddie standpoint, it's not recourse unless you perform, criminal bad acts of stealing. And then, then there's some, obviously it could become recourse, but majority of the time, the nice part is it doesn't tap into your balance sheet and allows you to kind of grow your portfolio without having to, worry about being on the hook for every loan at every property.
No, that's perfect.
Which every investor loves.
Yeah, absolutely. Thanks for clarifying that. Now, I know that you guys advise as well. So what would the scenario be if someone came to you and said, look, we're looking to do this. What is the best course of action? Would it be a bridge or would it be straight to agency? How do you guys approach that?
Well, really, I mean, the easy answer to that is, it all depends on what your long-term goals are. I mean, some people come to us and, the agency side of the equation is really, call it, depending on what market you're in, you either have to be 85% occupied for 90 days or 90% occupied for 90 days. A bridge loan might be where you buy a property, it could be well occupied at 90%, but if you put, $5,000 to $10,000 a door, you could raise your rents about $100 to $150 a unit. But you want an agency loan, but that, the agency loan you could get in a year to 2 years is much greater than the agency loan you could get today. So some people will bridge that to the agency loan. And then some people might be just fine with, taking the agency loan today and raising rents during that period of time. So it really depends on the strategy that the investor group wants or the strategy for that individual. But majority of the time, a lot of the bridge loans are a little less occupied and the debt service coverage isn't as strong as it would be if they put a bridge loan on it, raised the rents, cleaned up the units, put some new, carpet and floors in, made sure the clientele was appropriate. And, then they took it out in a year with a non-recourse, Fannie or Freddie loan.
Awesome. I want to paint a scenario for you, and I just want your opinion on basically why it benefits the passive investors invested in a deal. So it's a syndicated property, 100 units. It's in a bridge loan with a higher interest rate. And I come to you and I say, Jason, I want to refinance this. We've done X, Y, and Z. Here's the increased NOI. Let's refinance this. What are the benefits for the passive investors in the deal after we get qualified and get approved for that refinance?
No, that's a great question. I think, here's what some of the benefits is that depending on how long you've owned the property, if you buy an asset and sometimes the assets are not performing very well, you're not going to get a very good loan on it, or you're using a lot of cash, and you want to take that cash and you obviously want to buy other assets, that will refinance you with a longer term loan, whether it's 5, 7, or 10 year. It could be fixed or it could float, or it could be fixed or it could be hybrid. Those loans will basically help you lock in your investor returns over the next that period of time, and also not necessarily lock in your investor returns, but lock in your cash flow, and you'll know what your debt service is over that period of time. But it'll enable you to refinance that loan and then use that cash to go buy other assets and to repay some of the more expensive, lower leverage possible equity or debt that's on that property from the beginning. So, and this from doing this, across the board, John, is that, you could have a deal that's, not very well occupied, excuse me, and you have to, the only loan you can get is 50%. And then, so 50% of all your rehab costs and your purchase is all coming out of your investor's pocket and your pocket, which can get expensive over time. And then, once you get done with that rehab, you refinance it with a Fannie and Freddie loan, and you take some of that cash off the table, you go use that to buy other properties, and, you kind of grow your portfolio, grow your net worth, and grow your cash flow from there.
Yeah, that's very powerful, and how that transition seems to happen and allow you to grow your portfolio. So, Jason, a lot of great nuggets today, and I just want to say thank you, and I appreciate your time. But if you could leave our PI listeners with one piece of advice, what would that be in regards to lending?
So the one piece of advice I would say is that, make sure you really do a great job at operating your property well, and make sure you really keep good notes, good accountability on where you're spending your money, what you're doing, how you're raising rents, who your renters are. Because, at the end of the day, for us at Sabal, we think that we can solve every problem in the marketplace. And I know pretty much we can. I mean, we're one of the best lenders out there for Fannie and Freddie small balance, and even our bridge program as well. But, we really care about the operators. Are they good operators? We're required to run Google searches on the properties and run Google searches on the operators. So we want to work with really great people that know their marketplace, know their asset, know their clientele, and are quality folks to work with, that they're doing a great service for their community and really running great assets, and, helping the marketplace with affordable apartments out there for, great Americans.
That is awesome. Awesome. Jason, once again, thank you for your time. And I got one last question. It's going to be the easiest question of the day. How can we reach you?
Easy way to reach me. There's a couple different ways, but obviously on our website. So we are Sabal.com, Sabal Capital. So it's Sabal Capital, but it's pretty easy. It's Sabal.com. Anybody can reach me at jason.hull@sabal.com. You can get online. There's a lot of different, originators we have across the country they can reach out with, but you feel free, email me, call me. All the information is on our website. My email is an easy way to reach out to me. I'll make sure you get in touch with the people that are in your area. And across the board, we look forward to working with you and all your friends, for sure.
I appreciate you, Jason. Thank you again for coming on.
And also LinkedIn's always good too. I don't do a lot of Facebook, but I'm told I need to do it more. So LinkedIn's always a great place to find me as well.
Absolutely. I appreciate you, Jason. Thank you for coming on, man, and really thankful for you.
Thank you very much for having me today. Really appreciate it. Take care. Good luck.
PI listeners, I'm grateful for your time and I appreciate you for listening. For more information, go to PassiveInvestorShow.com. If any of this resonates with you, please subscribe and leave a review. The more you know, the more we grow. Thank you for tuning in. Till next time.